Hey everyone, thanks for being here. I'm Schaefer. I lead product for payment risk at Plaid. And over the last year, I've been focused on one question. How do we help companies grow their payments volume without taking on too much extra risk that they can't handle? So thus was born our Guaranteed Payments program that we're going to discuss today, and we're very excited to dive into. But first, as we built out this product and incorporated our core payment risk product, Signal, which we've had in market for about 5 years, we saw an opportunity to go even further, bringing in fraud intelligence to make our guarantee stronger. So I sought out the expert and brought in Anton, who I'm excited to have join me today. Anton, can you introduce yourself?
Yeah, thanks, Schaefer. I'm Anton. I lead product for fraud at Plaid. The problem Schaefer brought over was pretty straightforward. Payment risk signals are really important for ACH, but they don't tell the whole story. There's also the question of whether the person behind the transaction looks legitimate. So we started looking at how fraud intelligence could sit alongside payment risk and make the guarantee more reliable.
Awesome. Yeah, so Anton, before we get too into the product, can you give the people an understanding of why fraud data is such a critical piece of this?
Yes, of course. Payment risk is really good at ACH-specific question. Is this transaction likely to settle? It looks at things like balance history, transaction amount, and other signals that matter during that settlement window. Fraud is a different problem. It's about users who may be entering the system with the intent to create losses from the beginning. Those users move quickly. They often look fine if you only look at one transaction. So you need a user-level view and network-level view, not just payments-level view.
Exactly. We've always seen this problem get harder as fraudsters get more sophisticated. So the overall risk program is the problem that Guaranteed Payments is designed to solve. It's going to have both dimensions of Signal and Protect together. So for the discussion today, we're actually going to dive deep into both sides of the product suite and how they work together to deliver the results for your business. But first, let me step back and walk through Guarantee overall, and then we'll get into the parts. So the core challenge with ACH is that it's delayed settlement rail. You initiate a payment today, and you have an initial 2 business day administrative return window, then an extra 60-day user-initiated return window. And because of these 2 windows, you have to make a risk decision upfront with the data that's available. And this gets complex fast. A few situations might make this especially hard for your team. Maybe you're new to managing payments and you don't have the historical return data and calibration for your risk tolerance. You might be launching a new use case with a new customer profile, and maybe there's no benchmark yet on what that looks like. Or payments are just not core to your business. You need to move the money, but you're not necessarily looking to build a large dedicated risk team to do it.
And I'd add that it takes real operational experience. We've seen cases where the fraud pattern only became obvious after a team spent a lot of time digging through the data, especially with the amount of complexity of financial data that Plaid operates at. It's very hard to build a safe payments program overnight, and especially so if payments risk is not your company's main focus.
Exactly. So we worked on Plaid's answer, the guaranteed ACH settlement. And at the core, it's a very simple construct. Plaid backs every approved transaction. If we approve it and it comes back, we cover it. And our solution enables 3 core things. First, we guarantee the transaction instantly and unlock that moment. So real-time user activation, instant release of funds, immediate access, however your app functions. This will not require the use of holds. It doesn't need to. Second, better decisioning means better approval rates. With Plaid data, 500 million connected accounts, we have what we need to say yes to more accounts confidently. Higher approval rates, better LTV for your business and for your users. And third, you get to focus on growth and not just your risk team. We handle the complexities of decisioning, risk, and operations, and you don't need to build out all that infrastructure. So let's go ahead and walk through the mechanics of how this works. Plaid Link gets started and enables that seamless connection for the user while starting to review the account in the background. When we reach step 4, we have a very simple request on transfer. Request guarantee equals true, and then we'll go ahead and make that assessment of thousands of attributes from Signal and Protect and return a decision in milliseconds. If approved, you can release funds instantly, and you don't have to wait for the ACH to settle. If the ACH comes back, Plaid covers it. That's the guarantee.
Capping the downside risk matters a lot. Fraud losses don't usually show up in a nice, predictable way. They spike. You can have a quiet period, and then suddenly, seemingly overnight, a lot of loss attempts comes through at once. The value here is that when that happens, the business is not carrying all of that exposure on its own.
Absolutely. Basically running an insurance policy, and we have your back. And so at the end of the day, we'll go into what's behind this risk model to give you confidence in the outcomes that we can deliver. And basic engines are 2 things. Plaid Signal, which handles the payment risk and answers the question, is this ACH likely to come back due to insufficient funds or a closed account or some other issue with the transaction? And then Protect handles the fraud layer.
Protect is looking at the person behind the transaction. Do they appear to be who they say they are? Are there any behavior patterns that are suspicious? Is the network around their accounts look normal? That gives the guarantee more context than payment risk alone.
Absolutely. Cool. Okay, so let me walk through Signal first, and then I'll hand it back to Anton for Protect. All right, diving into a more concrete scenario, and we can look at our good friend Rob here, who's onboarding and wants to fund his account with $100 via ACH. He's a new customer. We don't know him, any of his transaction patterns, etc. yet. So with legacy risk controls, they would have had you put his funds on a hold. Less risk, and you can wait and see if the fund's actually clear and he has sufficient funds. But Rob then has to wait a few days to access his money and start to get value out of your app. But we could approve this immediately, which is a great experience for Rob, but there's risk. If the ACH returns, you eat the $100. Signal is the underlying model that lets you make the call with confidence on the payment risk side. So at a high level, Signal evaluates over 1,000 features across 5 categories: connection history, account usage, identity, prior ACH events, and account balances, and produces a risk indication. How likely is this ACH to come back? Its ML models have been trained on over $230 billion in assessed transactions and gives you high confidence of an indication of what to do. So specifically, the model is going to draw on some signals across 3 dimensions to give you this under the cover look: account balances, account activity, and network activity. And there's more to it, but here's where we'll start with some examples. Okay, so one thing the model evaluates is the balance transaction ratio over time. How large is this $100 from Rob relative to what he's had in his account before and over time? If someone's 90-day average balance is $1,000, a $100 deposit is a small fraction of that. But if that average balance is at 80, maybe Rob can't afford that $100, and it's a very different picture. So how does this compare over time is a critical thing that we're looking at for Rob. Next, on the account activity side, there's some very specific features that are really important when we look at the predictive weight here. So transaction velocity, canceled transactions, and historical return rates. A few examples here. So in some cases, we've observed 2.5 times more returns when the recent transaction count exceeds 1. So in the past 30 minutes, especially. So when it's basically saying that the higher velocity is higher risk. We've also observed that 3.3 times more returns occur when there's canceled transactions in the past 30 days, aka a history of declined transactions is an important weight as well. And lastly, we've observed 5.8 times more returns when the bank return rate is above 1.2% over the last 90 days. That basically means there's a concentration of risk across certain accounts in certain banks. These examples, again, are just a fraction of what we're considering in the model. There's many more features, but a sense of prior behavior in their account is a very important indicator. And lastly, the third dimension, the network. It's where data for Plaid really has an advantage, and it shows up clearly and is growing. We've connected over 500 million accounts and applications with Plaid, and millions or more are added per month, which means that we see behavior across all applications using Plaid and not just one. One example with account connections across apps, more than 2 in the last 7 days equates to 11 times more likely to return. That pattern isn't visible to any individual app. It only shows up when you look across the network. Cool. And again, one of many features, but it gives you a sense of what the network level data adds to the picture. So for Rob, let's say we see a healthy balance ratio, clean activity, no network stress signals, and signal evaluation comes back with low risk. We'd recommend to approve the transaction. And that's the payment risk picture. So then we go over to Anton and we layer in the fraud evaluation. Is Rob who he says he is? Is there anything else about his behavior across the network that looks like a coordinated attack? And that is the next element. So Anton, over to you.
Thanks, Schaefer. Let's look at what Protect is actually evaluating. So here's Rob again, but now we are looking at him through the lens of Protect. On the surface, he looks okay. He passed onboarding, the identity appears valid, the bank account is real, and from a payment risk perspective, nothing is obviously broken. But Protect is picking up a different pattern. 7 accounts opened across 4 apps in 48 hours. More peer-to-peer transfer activity than what is normal. So even though the transaction itself may look okay, the broader user profile is starting to look risky. And the result, the trust index score 32 means that he's higher risk than 74% of users for that customer. That's the important distinction. Protect is not just asking, will this ACH settle? It's asking, does this user overall financial behavior look normal? And these are related questions, but they're not the same. And when you combine them, you get a much better decision. The trust index is the scoring system behind Protect. It has thousands of attributes, device signals, behavior patterns, the identity signals, and it starts from the moment the user onboards to your app, and it picks up additional information as we observe more activity, both from your app and from the broader network. We built the trust index to help detect 4 major types of fraud attacks: stolen identities, synthetic identities, account takeovers, and most importantly, first-party fraud. Those don't all look the same. Account takeover looks very different from synthetic identity. So we need to pull from all these different data sources and combine these signals to get one risk score. The core idea is the user's digital financial footprint. It's not coming from just one app, but rather we observe it across the full network. And when it's happening, we observe patterns and whether they make sense. Single app does not see the full picture. A single bank does not see the full picture. And the network view helps us fill the gaps. And importantly, all of that is happening in real time. And real time matters. Fraud patterns can change quickly. And if you rely on stale data, you can miss the thing that just started happening yesterday.
Yeah, absolutely. That real-time and full picture really matters when it comes to the payments outcomes. We need richer evaluations to make more confident decisions, and that additional signal gets you higher approval rates, and we can back more transactions while controlling that downside risk on your behalf. That's the value of having both of these feature sets work together.
Cool. Let me show you a real example to make it really clear. So in this one real case, a customer reported a disputed transaction that looked like an account takeover. At first, it seemed like a one-off issue, but we decided to investigate. And when we mapped the connections of that user's bank accounts and their phone number and the devices, the graph did not stop at that one transaction. It kept expanding.
Okay, so Anton, this graphic is amazing, but I'm assuming everyone is thinking and wondering, what are we looking at here? What do these nodes and connections actually represent?
Yeah. So these nodes and connections are users and bank accounts and all of the different pieces that connect them together, like devices, phone numbers, and even if the same bank account is connected to multiple different apps, you would see that connection in the graph as well. And for this graph in particular, it kept growing and it got big very fast. We saw hundreds of bank accounts, many of them at smaller regional banks, connected to thousands of app accounts.
Okay, so this looks pretty big to me. I guess the question is this a common pattern? What do we typically see?
For normal users, no, it's not a common pattern. The thing about the graph is that we only put high confidence data in it. So for a normal user, you would see a couple bank accounts, maybe a few connections a year. It will not go big. But for the fraud operations, we see this pattern a lot. What looked like one incident was actually part of coordinated campaign. The tricky part is that for each account on its own, there was nothing suspicious about it. So that's how it looks from the network point of view. Schiffer, when that reaches payments, how does that look like for the business?
Yeah, I think that's the really interesting part. The trouble is that the attacker is initiating deposits eventually to or from a compromised account, but the payment history on the account looks clean. It's been used legitimately before, and the funds get released. But then, when the ACH returns start to come in later, across lots of different accounts, that money is moved and it's gone. If we connect that fraud layer and we can see those connections, as you've shown, Anton, we can potentially catch these before the losses happen. And that's the pretty powerful part.
Exactly. And that's why it's so hard to catch. These are real users, valid identities, successful onboarding events, and accounts with legitimate looking history. If you review them one by one, nothing necessarily screams fraud. What exposed this fraud ring was not one bad account, was the connections across many accounts. You had a lot of accounts that looked clean individually, but they were tied together through shared infrastructure and moving in very similar ways. And the second thing that helped us to identify this fraud is the geo distance. So we looked at the bank addresses and we looked at the location of the IP addresses of the connections, put them on the map, and saw that they were really far away from each other. And while it may appear normal for users that are just traveling, when you put that on the network view, this is not normal. So once we look across the network, the true fraud rate was 5x higher than what that customer originally calculated based on their internal investigations. And for that slice of traffic, we found 13 additional fraud cases. And that was not possible to see from reviewing single account in isolation.
So that's the full picture. When you take that payment risk and the fraud intelligence layer with the network visibility and feed it all into a single evaluation, we get a strong ability to back your transactions with confidence.
And for a company running a payments product, the point is that they do not have to build all of that detection system themselves. They get the benefit of more risk being caught behind the scenes, while their team can focus on the product experience and the business outcomes.
Absolutely. The goal is that we can handle it for you and you see better outcomes. So let me show you what that looks like in the numbers.
When we added Protect to the guaranteed payments evaluation, we saw 35% more fraud dollars caught. That is the direct impact of the fraud intelligence layer.
And that flows straight into the payments outcome. 41% reduction in ACH return rate for fraud returns. We're able to catch more fraud and fewer bad transactions getting through. The evaluation is doing more work across the board. So what is this ladder up to? In head-to-head test, Plaid Guaranteed Payments achieved a 24% higher approval rate against baseline logic. That's significantly more payments for your business. And then we're very excited to share that there's some companies that are already using guaranteed payments and seeing great results. Kalshi, a rapidly growing predictions market, and Zolve, who is extending credit to new immigrants to the US. We're very excited to support different use cases, but with the same challenge, needing to move money fast and deliver better outcomes for their business. All right, so thank you all very much for joining our session today. If you want to learn more, our sign up and our waitlist is live with the URL here and our docs. So very excited for you all to get started with Plaid Guaranteed Payments. And then I believe we have some time for Q&A and a few questions coming through. Okay, let's start with the first one. You guys talked about how Plaid covers transactions if they are approved, but what happens to transactions you decline? Excellent question. So the primary thing that happens when we decline a transaction is goes back to you as the customer to make a further risk decision. Would you like to route the user to a different payment method? Maybe we ask them to connect a different bank account, or we could go ahead and put that transaction on a hold as it's processed and just wait to see if any of those administrative returns come in before we release funds. So there are absolutely options. Don't have to hard decline all transactions that are not guaranteed by Plaid, but take it into consideration. Okay, great. Question 2. Are there any limits on what Plaid will cover? Is it always a full guarantee on all types of transactions? Great. So what we are proud to say is that we will offer a full guarantee on transactions that we have set up in our program with you as a customer. And so there are likely going to be things that we discuss in terms of dollar amount caps or conditions in which we will cover certain returns. But overall, we are prepared to give a full guarantee on all transactions from consumers. So we're excited very much to explore that with any customer who's ready. And if you want to sign up for the waitlist, we'll be eager to go ahead and review your business together. Awesome. Okay, I think that's the time we have today. Thanks everybody for joining. Thank you, Anton, for joining me on this presentation and for all your work on this product together. It's been awesome. And yeah, we'll chat with you all soon. Thanks, everybody.
Thanks, everyone.